Thanks for joining us for the executive series today. I'm talking to Dr. Don Hamson, who is the Managing Director and Chief Investment Officer of PLATO Investment Management. Don, good to talk to you.
Good to be here.
Now let's talk a little bit about the organisation, because there is a specific focus that you have as a boutique funds manager.
Yeah, so our area of specialisation is after-tax management, but in particular for retirees and building portfolios for what they want, which is a high level of income, but also taking advantage of their tax situation.
Okay, and in terms of like the investment remit, do you invest domestically, internationally?
Well, our major focus is Australian equities, but actually we launched a small global income strategy most recently. But we're best known for our Australian Share Income Fund, which indeed we're now taking to market as an LIC as the PLATO Income Maximiser.
Okay, so just walk us through the key elements of this income maximiser fund.
Yeah, so as I said, our specialisation is delivering income for retirees, and it's based on underlying strategy which has delivered 9% income, including franking credits after fees, since inception over the last sort of 5.5 years. So it's very much aimed at retirees who want good, solid income, and a particular feature on this PLATO Income Maximiser is we are looking to, once we build up some profits, actually pay out monthly income, which is going to be the first actually listed investment company in Australia that actually pays out monthly franked income.
And why did you choose an LIC specifically?
Well, it actually provides the structure to be able to pay out monthly income on a sort of sustainable basis, because a managed fund has to distribute everything each year, and so you can't actually bank some income one year and for the next year. You have to pay it all out, and so a listed investment company can actually build up some profits and actually smooth those profits out over time, and so it enables the ability to pay smooth monthly income once you've built up some profits.
Okay, and that's obviously favourable when you compare it to other income products.
Yeah, certainly we see a lot of demand. Indeed, even a couple of people I talked to today that end clients see a real value in getting regular monthly income, because most managed funds and listed companies, and even your own company, CommBank, you pay dividends usually twice a year. Some managed funds actually only distribute their income once a year. Now, if you're retired and you no longer have a salary, getting regular monthly income, I think, is valued by a lot of people.
And what's the typical type of investor that you'd be targeting with this LIC?
So the other reason to bring the LIC to market is we're targeting really the self-managed super funds and the self-directed self-managed super funds, which often invest in listed investments and don't usually invest in managed funds. So that's a sort of area of the market that we really don't have any penetration to, and so we think this is a product that they will certain SMS, particularly retired pension phase, will want, but it's a market that we just don't at present have penetration of.
Okay, and if you were to estimate the size of that market, it's the demographics would indicate that it's increasingly becoming larger and larger.
Oh, most definitely. I don't have numbers on the amount of self-managed super funds in pension phase, but the volume of self-managed super funds is in the order of $600 billion. So it's actually the single largest market segment within the $2 trillion superannuation market is actually self-managed super funds. And by and large, they tend to be people who are older, have much larger balances, and often that they're either in retirement or soon heading into retirement. So that's actually quite a large portion of the self-managed supermarket.
Okay, and give us a sense of the investment profile of the fund in terms of the sort of sectors that you're favouring in terms of investment.
Yeah, well, I suppose that's a unique feature of our fund is that if you clients might immediately, investors might immediately think, well, if you're delivering very high levels of income, then obviously you're going to be overweight the banks. You're going to have a very large portion of the banks in the portfolio. And that's not the case. In fact, I'd actually put it to you, if all we did was invest in banks, well, people can do that themselves. So, why would we bring something that people could replicate? We actually very actively manage this portfolio, and we trade that portfolio to capture more dividends and across the whole gamut of the market. So yes, we get a fair bit of income out of the banks, but we're not overweight banks, and so we're very well diversified, holding a portfolio of sort of 90-odd stocks in the Australian marketplace, but without any real biases. It's not just, it's not 4 banks and Telstra in this portfolio. It's a very well diversified portfolio, and that enables it to deliver consistent income, because if one stock, like last year BHP cut its dividend by 80%, well, we just buy the stocks we don't get much income out of BHP, but we move to other stocks that do. So that enables us the flexibility to move around and capture more income for clients.
Well, great talking to you today. Thanks for your time.
Thank you, Tom.
Thanks for joining us for the Executive Series.